Well, welcome everybody. We'll let people continue to just kind of pile in here. For those of you that are here, I will just let you know that we will have the live microphones off at the beginning here. So if you do have any questions, please type them in the chat or the Q&A box down in the bottom center of your screen. I'll continually be looking at that as we go through this. So that way, if you have a question, type it in there and then I'll ask our presenters. So my name's Kyle Kite from Klaas Financial, and then we've got Nate Bribey and Luke Olson here as well. But like I said, give us just a couple more minutes, let people trickle in, and then we'll get started here real soon. Perfect. Good. You starting to get some good color change up there, Luke?
Yes. I noticed it was kind of, I don't want to say peaking, but I noticed it the most vibrantly last week, and then we've had pretty strong winds the last few days. So I think it's more on the downward trend by where we are.
Yeah, absolutely. I just had a client, he went up to La Crosse here, last week, I think, and he said it was about perfect up there. So
it was, I would say the beginning to middle of last week, it was really great. And then kind of over the weekend, it got windy, and now it's not a lot of leaves are gone.
Right. All right. Well, welcome everybody for coming. Those of you that weren't on just a second ago, my name's Kyle with Klaas Financial. We also got Nate Bribey here from Klaas, and then we have Luke Olson here from Robert Roth CPAs up in Madison. As I mentioned before, we do have the microphones turned off for each of you, just so we don't all talk over each other and everything like that. But if you do have a question, please type it into the Q&A at the bottom of the screen or the chat. You can just click on those boxes and type it. I'll be constantly monitoring it. So that way, if we have a question, when our speakers take a break, I'll be able to ask them your question. And then at the end, we will open it up for questions as well. There's also a raise hand button down there at the bottom. So if you want to hit that too, then I can turn your mute off of your microphone and you can ask it live as we go along here too. So with that, I think we've got just about everybody in here, about 3 minutes after. So Nate, why don't you go ahead and start us off? Give us the intro and all that good stuff.
Yep. Welcome, everybody. Thanks for joining. Like Kyle said, I'm Nate Bribey. I'm an investment advisor here in our Illinois office in Loves Park. For those of you who don't know, Klaas Financial has been in business since 1976, so we're in our 46th year of business. We are a fee-only registered investment advisor, which is a fancy way to say we are fiduciaries to all our clients, when rendering financial advice. So we specialize in retirement planning, helping people get to retirement and through retirement. And a big focus of that we're going to be discussing today is part of the financial planning process is after we've determined you have enough assets to retire comfortably, what's the most tax efficient way to get money out of a retirement account? And those are some of the big things we'll be talking about today with distribution planning, smart ways to make charitable donations in retirement. If you plan to pass wealth on to the next generation, what are some smart strategies we could be deploying now in our retirement years to maximize taxes for our children or minimize them rather, and things like that. So we have Luke here today, a CPA, like Kyle set up in Madison, that's going to be the subject matter expert on things. But just know that, Kyle and I and the rest of Klaas Financial are not tax preparers or accountants. So that's why we like to bring in experts like Luke to actually render advice to clients and prepare tax returns. Kyle and I like to present strategies to our CPA partners and recommend they explore further with their accountants before they implement them. But Klaas Financial does not do tax preparation or returns at this point. So Luke, we'll hand it over to you. If you could just give a brief background of your firm and what you do for your clients, and then we can kind of go into some of your prepared remarks.
Perfect. Thanks, Nate. Yes, again, Luke Olson with Robert Roth CPA in Verona. We are just south of Madison. Robert Roth has been doing tax work now for, I think he's been here for about 25 years. I've been with him for just over 11 now. I have been a licensed CPA for 3. That test is extremely brutal. And then family planning got in a little bit in the way of that, getting that done. We focus primarily on I would say more so individual tax preparation at this point. We're about 75% individual, and then the remaining is business, and then we do a few not-for-profits and like trust type work, but a heavy emphasis on the individual tax stuff at this point. We are a year-round office, which I found that many clients like, because if they try to get a hold of their accountant for a question, we're not on vacation throughout the whole summer. I've heard that complaint before. So we're year-round. We do a lot of bookkeeping, off-order payroll, that type of stuff to our business clients, just to help them and keep us busy throughout the year. So that's really who we are. Don't plan on going anywhere. I will be taking over this firm in the next year or so. So it will be Luke Olson or something. So I will be around for many years to come and keep this business going strong. With that, we can jump into the focus today. We'll start with the RMDs. Nate, do you have that? Is that table kind of up?
Yep, I'll pull it up for us to look at briefly.
Perfect. So as of January 1st of this year, as you can see, the RMDs changed slightly. It doesn't seem like a lot, but it can be a few $1,000s annually to extend the life of your IRA accounts in retirement. Personally, I was kind of surprised that they did this, given that the debt that we have as a country. I would think they would have wanted to leave it the same or maybe reduce it a little bit to get the revenue. But that's just personal opinion thought there. I don't know if you guys have thoughts on that at all. But I didn't think it was going to get extended, but it could be useful in that you reduce your taxable required withdrawal every year. Having said that, I know Nate and Kyle, we talked about maximization of tax brackets using RMDs. So I look at that as we could use the RMDs, even though it has to be this certain dollar amount. Maybe we need to do a little bit more to stay within a certain tax bracket. We do that planning quite often. October, November, I'll have a client call and say, hey, how much do I need to take out, or what can I take out to stay in the 22% tax bracket, 24% tax bracket, those kind of things. I feel like that provides a lot of value to them because we can pull out more, and then you can invest that excess distribution into something that can be passed along to heirs better, from a better tax strategy than an inherited IRA, which we'll kind of touch base on later. But as far as the RMD tables go, there's just not, that this change didn't affect a lot of tax strategy other than it reduces the amount of money that you have to pull every year. But very often, the clients that we're working with, we're not really worried about how little we can pull out. It's more what can we do to maximize a tax rate situation versus how much money do I have to pull out this year. Does that make sense? Are there any questions on that topic?
I would just clarify here so everyone's aware of what we're looking at. The blue column here was the old tables, and the green column here would be the new tables. So it is kind of complicated. Well, not really, but you basically take your year-end balance and divide by this factor here. So that's what they did. They extended the life expectancy tables. So it's a higher factor resulting in a lower withdrawal rate. So to Luke's point, there's really not a huge difference, but that was a common question we had this year that, hey, it appears my minimum's a little bit less. Why is that? Well, that you can see it was roughly 4% before. Now it's roughly 3.5% for a starting factor. So the other thing we had mentioned is that these change every year as far as they use the previous year end balance to calculate these. And with the stock market obviously being down year to date, there could be a good expectation that if the market doesn't recover in the next month and a half, next year could result in lower minimums as well, just based on how the math works out. So
Correct.
Mm-hmm. And a lot of you will remember it used to be age 70 and a half, which is why this blue column starts there, but then they change it to 72. So when you hear friends saying, oh, you have to start taking money out at 70 and a half, they've actually changed it to 72. And that was the wonky thing, is that they changed it to 72 without changing the table for a couple of years. So basically what they did this year is they just shored it back up to where what you used to take at 70 and a half, now you take at 72 versus having to take more out once you get there. So.
Luke, one more thing. Do you want to mention what accounts are subject to this table? What type of retirement accounts?
All the pre-tax retirement accounts. So your IRAs, your SEPs, 401k, all those pre-tax accounts that are not ongoing. So, just those pre-tax dollars are subject to those RMDs.
Yeah. But basically, the IRS says we've let you defer your taxes for long enough. Please take out a little bit to pay some tax on now. So that's kind of the logic behind the schedule and all of that. So
which is why I was surprised that they reduced it, because in my mind they're broke. They need the money.
Yeah, and I
but
think
people are living on average 6 years longer than they did 20 years ago. So in that mind, it does make sense. Mm-hmm. The other random thing to think about is how old are all the people in Congress? If you extend those out also.
There you go.
Right. Yeah. And another just quick comment for everyone is you cannot combine RMDs from 401ks and IRAs. So this is a misconception sometimes. So if you have multiple IRAs, you can put all your RMDs together and take that out of one IRA. If, however, you leave money at your employer inside a 401k and you also have an IRA, you actually have to take money out of each. You can't just take all of that out of one account. That's one caveat that some people get tripped up on sometimes. So.
Yeah, very good.
Perfect. I think next let's talk about the inherited IRAs and the 10-year distribution versus the old stretch IRAs. That one was a big change in 2019. I don't know how many people here have dealt with that, but effectively what happened was prior to 2019, if you inherited an IRA, you could stretch that out over your lifetime expectancy. So whatever that is based on tables that the IRS has. Now, if you inherit the IRA, it has to be pulled out within 10 years. There are a few exceptions to that. One being you are the spouse that inherits it. It is inherited. The beneficiary is a minor child, not grandchild, but a child, a chronically ill person, or someone who is not 10 years, not more than 10 years younger than you. So if you were within 10 years of the person who you inherited it from, it could also be carried over your life expectancy. With the minor child, it is the life expectancy of the child until they reach the age of majority, and that being 18. Once they reach that age, it has to be pulled out according to the 10-year rule. So that's the little niche there. Those are the 4 exceptions. So with that 10-year rule, you have the ability to pull it out all at once. You can do random amounts each year, but by that 10th year, it has to be pulled out. If it is not, you are subject to, I believe it is a 50% excise penalty on the amount that had to be pulled out. So that is a very stiff tax on not doing it properly. So this one is a big one to make sure that is being done how it is supposed to. The other thing I know we talked about briefly last time Nate and Kyle, when we had a meeting, you asked about inherited IRAs that are already in RMD, or already giving out RMDs. Those need to continue. So if you inherit an IRA that's already giving out RMDs will need to continue. The first year you can do the owner's RMD, you can do that amount, and then it goes according to the table. And the same thing, the amount has to be totally withdrawn over 10 years. So it'll be minimum, and then over 10 years it has to be gone. But the key is that RMD needs to keep coming out. You can't not do it for a year, like if you had inherited it prior to the fact. For tax planning purposes, this one can get interesting. Depending on how much is in that IRA, you could have some major tax problems for the beneficiaries. And we'll kind of talk about other strategies with IRAs later. But getting that 10-year, if you're depending on your income variations, you may want to do a lot and a little, or just streamline it over the 10 years. But that one's kind of a unique one. That one was the government wants their money now versus waiting.
I would just add that that's definitely a thing to be aware of. If you know somebody that inherits a retirement account, that's definitely a time to hit the pause button and seek financial guidance through your accountant or financial planner. Because what Luke is talking about is really like the tip of the iceberg. It depends who you inherited it from, what's the age gap, the relationship between you and the person you inherited it from, what's the age gap between you and that inherited person, when did they die, and how old were they when they died. So you have like 4 or 5 variables that could affect what the rules are and when and how you have to distribute those assets that we don't expect any of our clients to memorize or know by themselves. And that's why you hire good professionals to help you with that. So just know that is a huge deal, a huge change. So any retirement accounts that you or anybody else would inherit would be subject to new rules if the decedent passed in or after 2020. So something definitely to be aware of, and hit pause and seek financial guidance on what to do and when. So
yeah, definitely. That one is a big one. You don't want to. That one requires a lot of planning, because you definitely don't want to give them more than you would otherwise have to. So there's ways to plan for that 10 years to make it maximize your tax efficiency of those dollars.
Luke, one more wrinkle, if I could add to this. So let's say dad passes away at 80. His minimum for the year is $10,000, but he passes away before that's satisfied. And he gives it to 2 kids, leaves it to 2 kids. Okay. How does that 10,000 get satisfied? Who takes it and when and how?
The kids have to take it.
Yeah. And either or, right? One can take all 10 and the other could take 0. And so you can maybe give some advice as to how you see that in practice worked out?
That's a unique situation. I've never dealt with that. I would, in my mind, I would limit, as long as those 2 beneficiaries are on good terms, I would figure out who's going to minimize the tax effect of that $10,000 and give it to them.
Yeah.
And then figure out how the rest is going to get divvied up later. But essentially, you're trying to figure out how to pay as little tax as possible on that money.
Yeah. Sorry, that's a stumper, but I just
that would only come into play if they were massive different tax brackets. Like
yeah,
one was paying 0 and one was paying 30% or something like that, maybe.
Yeah.
But
in which
but
case,
there again,
there are that situation where you have, I had a client that had a bunch of stock, and they have, they're not ill or anything, but you have one child who's a doctor and another one who's over here, and one's making, in the 30% bracket and one's down in the 20, that I would save that 10% on that by shifting it down here.
Mm-hmm. Yeah. And on this rule that they changed, the 10-year rule, this definitely impacted people that had maybe even set up trusts to where you let your kids, you put the IRA in trust so that your kids can only get a certain amount out, or nephews, whatever it is. But now that they put this rule into play, it kind of null and voids out all the work you did with the trust. So that's why you're getting a lot of, if you've had a trust with a good estate planning attorney, they reached out to you to say, hey, we think some things have changed and we need to update this. That could be part of the reason why, because this was the way that we used to plan for this. If you wanted to, is you could stretch it over beneficiaries' lifetimes, like we said. Now it's got to be out within 10 years. So all the language that you used to use, you can't really use anymore. So that's where, again, like we said, that's where they're making up for letting you let it sit for 2 more years. They're just getting it back from the beneficiaries a lot quicker than they used to back in the before this.
Right.
So
Yep.
And I would just say again, this, if you have large retirement accounts, say $500,000, $1 million plus, and that's the bulk of your net worth, and your goal is to leave a legacy to your children, right? This is another reason to hit pause and seek financial guidance, that maybe that's not the most effective way to hand a kid a $2 million pre-tax IRA, right? Knowing that has to be distributed over a 10-year period, that's $200,000 a year. What could mom and dad be doing, now, in the golden years to maybe lessen that blow for the whole family's benefit? So,
Yes.
So I think that kind of goes in, Luke, if you want to go into Roth conversions and things like
we
that.
Talk about the Roth conversions, and we'll talk about the QCDs after that. Roth conversions is a big thing right now. I have had more questions on Roth conversions in the last, let's say, year and a half than I have ever had. Specifically, how do I stay with, again, that comes back to tax bracket utilization. So how much can I pull out of how much can I convert to a Roth and stay within a comfortable tax bracket, or a tax bracket that I'm comfortable paying, depending on who the individual is. Some individuals are willing to pay in the 25, 26 effective bracket. Some want to stay in the teens. So I do a lot of planning in October, November. I consistently have a couple clients that call me and say, my investments are going to be this. I did this much in my business this year. What can I convert to stay within a certain bracket? And I mean, typically it's $20,000 or so, but that's $20,000 that you're paying a lower tax bracket than if you have to do a 10-year, your heirs inherit a 10-year and it's 200,000, where they're jumping probably into the 30% tax bracket. So it's much more effective to pay tax dollars on a conversion than the inherited IRAs right now. Typically, I guess there could be unique situations where it's not, but from what I see, that's been a very good strategy in the early retirement years to get some money set aside for beneficiaries, if that's your intent, to get some money that's not going to be taxed. Roth, we could talk for hours about Roth conversions. There's a lot of things to consider when it comes to planning for Roth conversions. How much income are you going to have? I guess you start with, what tax bracket are you willing to pay on this conversion? What tax bracket potentially could, not just excluding the heirs, once you as a taxpayer have to start doing RMDs, how much is that RMD and what tax bracket is that going to put you in? Because at that point, you're taking Social Security, which your RMD is most likely going to make 85% taxable. So you're going to have income tax on Social Security. You got your RMDs plus any other investment accounts. So if you have a substantial IRA that's coming into RMD, you could be jumping yourself multiple tax brackets. So planning when you're in your late 50s, early 60s, conversions are a great thing. We've been doing advising people to do a lot of them. the things that I see that explode that plan are the investments that shoot off capital gains. The mutual funds that distribute gains, you could plan for 5,000, 10,000. Well, in the last couple of years, it's been 20,000, 50,000. If you have a substantial portfolio, you don't always know what those are in October, November. They might not hit till December, and it could kind of derail your plan a little bit as far as staying in a certain tax bracket. So that's one thing I like to consider. The other thing is Social Security. If you're on Social Security and you're going to convert, do some Roth conversion, is that Social Security going to become taxable, and how much do I have withholding on that? So you need to plan for that, because those are the things that I don't like having the surprise of telling a client that after we've done a conversion. I kind of want to know in December, if I'm doing a plan for a conversion, I want to know in December what their tax return's going to look like in April. I have the ability to pretty much plug everything in to my planning software and kind of figure that out. But you do have those outliers of the financial instruments shooting out some dollars that we aren't aware of. And I always be upfront about that with people.
I would just kind of throw in an example too, and Luke, you started with a good one where, I agree completely with Lucas. Someone that would be a good candidate for Roth conversions would be potentially someone that just retired, so they don't have their high salary, from work anymore. They just retired. They're 60. They are not eligible for Social Security yet, and we advise them to wait till full retirement age, let's say 67, right? So they have 7 years basically of no income, absent a pension and other part-time wages, right? They're drawing on some cash at the bank, or we're sending them a little bit from the IRA, and we know that they're securely in the 12% bracket with a little bit of room there. Luke could do some analysis to say, hey, Kyle, you have 700,000 in your IRA. If you let that sit for 10 years, maybe that's going to double to 1.4, and that's a, 70,000 RMD or whatever the math is, right? If you do nothing, we're projecting you go from 12% bracket to 24%, let's just say. Okay. Luke would say, hey, maybe we should balance that out and take out 50,000 a year to fill up the rest of that 12% bracket, or maybe even go a little bit into the 22, because that's going to, one, reduce your future required minimums and bring down the amount that would eventually spill over to the 24% bracket if you do nothing. So I always like to say, that pre-tax money, we can't control that it's going to be taxed, right? Whether mom or dad pay tax on it or the kids pay tax on it, someone is going to pay tax. We can't control that. But what you can control to some extent with good advice from a good accountant is, how much you pay and what rate, right? So that's where working with a good accountant like Luke is to say, hey, I think you can take out 20,000 this year and only pay 12 instead of 24. Well, that's a nice break you can take there by being smart about when and how you pay the tax on it too. So,
right.
And Luke, do you want to mention our? I guess we can just now in a down market as well. Kyle, you want to explain that why when a good time to do Roth conversion is?
Yeah, sure. So definitely when you're looking at your statement right now is obviously down from where it was at the beginning of the year, but this is actually one of the best times to convert to Roth. The reason that is, it might seem counterintuitive because you say, oh, you don't want to take money out when it's down. But what you're doing is, remember, dollars and shares are two different things. So while the share price is depressed right now because the market's down, you can actually convert more shares for the same dollar amount that it was 6-8 months ago. So you're taking depressed share prices, meaning you're paying less, you're converting more shares for the same dollars, and now you're putting those same shares into a tax-free growth wrapper, basically. So when the stock market's down, this is actually some of the best times to do some Roth conversions, because again, you're just giving yourself more room. You're converting more shares for the same dollars. And the other thing I would mention about Roth conversions is you're trading the known, meaning we know what tax brackets are today versus where they're going to be 10 years from now or 15 years from now when you're taking required minimum distributions. Well, we're at practically record low income tax bracket. So we can't say for sure that they're going lower, but the bet would be that if anything, they're going to probably go higher with all the debt that we have as a country and that kind of thing. So I don't think we're going to go much lower from here. And that's, again, where we're at today. Even if it's 22% today, in a couple of years, that could be 25%, very easily, actually. Like if they don't make any changes, it goes back to 25%. So it can even make sense in some small situations like that, where you're just paying 22 today instead of 25 in 3-4 years from now if they don't change any rules. So
I have one more thing to just think about as far as Roth conversions go. Thinking about IRAs when they get into RMD status, you have a married couple who are similar ages in retirement, and they have to go to RMDs. One spouse passes. You now have a spouse that is going to shoot into the single bracket, which is far less forgiving than being married. For example, let's say there was $100K of income coming through from a taxable income standpoint. As a married couple, that tax is about $13,000. As a single person, it's nearly $18,000. So if you can convert money to get it to a after-tax account, you don't have to worry maybe that dollar amount later in life, if one spouse passes, you're going to have more income taxed at a higher rate because it's a single tax situation. We see this every once in a while, and it's one of those things they don't think about for the year, and then they have a major tax problem because they were married. Now they're filing as single, and all of a sudden they owe $5,000-$6,000 because they didn't take into account the income really didn't change, but their tax status did. So that's one other reason conversions now can help offset that a little bit later, just from a planning standpoint. No one likes to talk about death or taxes. So,
well, Luke, just to clarify, so if you lose your spouse in 2022, for example, you'll be able to file jointly for 2022, but the following tax year, you would be single, correct?
Correct.
Absent a new marriage.
Yep, absent a new marriage. So whether the spouse dies on January 1st or December 30th, you're still married for that year. But then the following year, a lot of those things, that's something that gets overlooked a lot. Typically one spouse handled the financial / tax situation. If that spouse happens to be the one that passes, and you have the other spouse that really had no clue what was going on financially or tax wise, that sometimes gets overlooked as far as when they're talking to their investment person and they're not withholding enough dollars on the same income, because they were in the 12-15% tax bracket. Now we're in the 20%, 24% tax bracket. So doing Roth conversions to minimize that that pre-tax money that you're going to have to pull out later can help there a little bit.
I would just reiterate what Luke said is so important. If you unfortunately lose a spouse, or somebody who has, that's a great time to see your accountant to adjust withholding. For example, on Social Security or on a pension that you have a survivor benefit on, or you're taking money from a retirement account with us, that is definitely a time to check back in with your professionals to make sure you don't have a big surprise that first time you file single, because things greatly change. Even if the income coming in month to month is the same, Luke's saying that the tax could be higher because you're filing single than jointly. So very good.
Perfect.
Well, good. So that's Roth conversions in a nutshell. Like I said, that all kind of ties together with the inherited IRAs and how do we maximize the wealth for a family, not just mom and dad, but the kids potentially too. So that's, we deal a lot with retirement accounts, and a lot of you folks have them with us. So that's something we're going to be talking about for many reviews to come. How do we maximize the after-tax wealth for the family? I think is the simplest way we could kind of wrap that up. So, I think next we'll transition into qualified charitable distribution. So this also ties in with required minimum distribution. So I'll kind of try to tee this up for you, Luke, and a lot of numbers and a lot of things that kind of relate here. And so let's say that a client has $500,000 in a pre-tax IRA with us or another firm, and they are subject to required minimum distributions at 72, and let's just say it's $5,000 a year that they have to take. If they take that out, and report it as income, it's taxable. But if they're charitably inclined and they donate to their church regularly or a university or any other, nonprofit institution, you can utilize a strategy called a qualified charitable distribution and not pay taxes on it. And look, I'm not going to steal all your thunder here, but the one thing we'll mention here is this can actually happen the day you turn 70 and a half, right, Luke? It's not the tax year, it's the actual day. I believe that you can do this. So even if your minimums, Kyle said, start in the tax year you turn 72, the day you turn 70 and a half, you can start utilizing this strategy, correct, Luke? So
it's one of the funky things that they haven't shored up yet.
Yeah.
Because again, RMDs used to start at 70 and a half, so QCD started at 70 and a half. I guess to take a step back, why did they come up with qualified charitable distributions? It's back when they changed the standard deduction. They made it so high that many people that used to itemize their deductions with their charitable giving, they could still itemize it. But now that the standard deduction is so high, many people lost the itemization, but the government didn't want to disincentivize being charitably minded. So they put something in called qualified charitable distributions. Again, it started at 70 and a half when RMDs used to be 70 and a half. Now RMDs are 72 age, and this is still 70 and a half. So will they change it in the future? Who knows? But
I'd like this strategy if you don't need the money. Obviously, I guess you could use cash and just use the qualified charitable donation from the IRA instead of using your cash from on hand. I have a handful of clients that use this strategy. Even though they were itemizing, it's just they were barely itemizing. So why not take the RMD, whether it's, I have one, I think he was a doctor. He just gives his RMD from one of his IRAs, goes to charity every year. So it basically reduced the amount you donate to charity through a QCD is dollar for dollar reducing your taxable income. So it's a great way to save a little bit of money and still accomplish the goal of donating to charity. And like Kyle said, back when they changed the standard deduction, doubling it, a lot of people weren't itemizing anymore. And I think a lot of charities were suffering from that. I still believe that there is an issue there because there's a lot of younger people that used to donate that they still do, but maybe not in the capacity or frequency as they did previously, because they don't see a tax benefit of it, which isn't the right reason to give anyway. But if they like getting that tax benefit by doing that. So using the IRA to give, it has to be directly from the IRA to the charity. You cannot take possession of the money. That's one of the sticking points there. So it'd have to come as a check directly from whoever the funds are with to the charity to be deductible. But it's a great way to reduce that taxable income. You can do it's limited to 100,000 a year. So I've never seen anyone come close to that. And it's per account owner. So husband and wife or spouses could each do the 100,000. It is limited to that. There is no carry over of if you went extra. So it's just the 100,000 per IRA owner. But it's a great tax way to save a little bit of taxes. It's not huge, but it is a good way to reduce some income and accomplish the goal of giving to charity.
Mm-hmm. And I think that the take-home point is just that you don't have to itemize to receive this deduction, which is one of the very few, correct, Luke?
Yep. Yep.
So that applies. I don't know, 93% of people don't take the standard, Luke. I would guess 9 out of 10 would be the statistic.
It's probably 8 out of 10 in my world.
Okay.
Are doing the standard deduction now. Effective. A lot of them are barely over if I see it over. And a lot of them that are itemizing are not in retirement. It's the most retirees who would be looking at taking money, using this strategy are not itemizing anymore.
Right.
Unless they have substantial medical expenses. The people itemizing are the ones with the mortgage that's generating $15,000 of mortgage interest and capping their $10,000 SALT, so state withholding and property taxes, and then they're getting a little bit of the charitable donations on the back end of that. So it's a barely itemizing, but I would say that 8 out of 10 are now in the standard deduction.
Sure. And I think that's a frustration we get from clients as well. You do this, whatever the strategy is you can deduct that. And then your accountant says, if you itemize.
Right.
What you don't. So just hear that this is a very powerful strategy for most folks who perhaps don't itemize, but still want to give. This makes a lot of sense. And this is something that Klaas Financial can help you with, directly from there. We do say that we do recommend that, for larger donations. So, if people like to give $200 to their church, sizable amount. So a couple thousand to any one institution is kind of where we like to draw the line to say, hey, if you give the Salvation Army $100 around Thanksgiving, that's great, but we'd rather you just take care for that out of your pocket, out of your checkbook. But if you give $5,000 to your church to renovate the entryway, we would be glad to help you facilitate that QCD, because you're going to see a meaningful tax difference, right? 12% on 5,000 is a lot more than 12% savings on $100 there. So that's just the one thing that we like to share with people, that larger distributions to any one institution does make a lot of sense to do it this way. So, yeah. And last point on that is just to communicate effectively that it is a qualified charitable distribution. So if you were filing with Luke and said, hey, I gave $2,000 to my church, he's going to say, a good accountant would say, was that a charitable distribution or did you write a check, right? But I'm sure you could think of an example where it's a miscommunication and they actually do not record that correctly. No fault to the accountant. That's just the information they got from the client. So correctly communicating that it was in fact a charitable distribution to make sure you get the benefit of the strategy too. So that's something we try to help with, is communicating that correctly with Luke and other accountants, that this was in fact from the IRA as a charitable distribution. So
yeah, because these don't really show up on your tax documents when you do them. So you have to remember that you did them and let the accountant know that you did them as a qualified charitable distribution. Many people like to get receipts, so that would be a great thing to keep it in your head that, yep, I did a qualified charitable distribution and here's a receipt for it. But
right. Because the full amount of the IRA distribution is still showing up on your 1099-R showing the IRA distribution. It does not account for any charitable donations on that form.
Yeah. One last point, Luke, can say a client has their money in their 401k plan through their former employer. Could they do a charitable distribution from the 401k plan?
I do not believe so.
No. So just be aware of that. If you have money in your 401k plan, you would still be subject to an RMD at 72, but you can't take that minimum and donate it to the church or whomever and get a deduction. It has to be within an IRA. It doesn't have to be with us. It just has to be with an IRA somewhere. So, yeah. Very good. Any other thoughts, Luke, on that?
No, I didn't. We didn't talk. I know Social Security is a big one, whether to take it early or not. How often do you guys, I know it wasn't on the topics for today, but I thought we could just touch on it briefly.
It's a common question, so we're happy to explore it.
I get that question annually from many clients. And it's always, well, what does family history look like? So are you gonna, does your family history say that you're gonna kick the bucket at 75? Or does family history say you're gonna live to be mid-90s? Is one of the things the big questions that we talk about. If family history says you're not going to not live very long into your 80s, we look at taking it early, because you could get more benefit from those dollars now than waiting until it's at full value. Could you take that money early and invest it and earn more than the increase would be the other thing that we talk about. I'm sure you guys talk about that also. And are you going to need how long are you going to need Social Security later in life, or do you have enough other assets? Whereas you could take it early and use that money to do things while you're still in good health. It's kind of the three questions that I typically will ask back to a client who gives me the question of, should I take Social Security?
We could go another hour on that topic, right, Kyle?
It's a great start, Luke, but I got a joke for the answer. Tell me the day you're going to die, and then I can tell you when you should take Social Security, right?
Yep. I always tell people, walk out of my office and get hit by a bus.
Yeah, it all becomes a real simple math equation when we know the day you're going to die. So,
right.
Yeah, so to that point, there's multiple factors, and you have to look at your whole plan, what your assets are, all that kind of stuff. Some things to be, I guess, aware of. If you take it before your full retirement age, which for most people nowadays is 67 or close to it, 66 and 8 months, 10 months, or 67 for most people. If you take it before that full retirement age, they do put a limit on how much you can earn. So for those of you that are retiring out of your long-time career, but you're not ready to completely stop working, or you want to do something else with your time, if you're going to make more than, it's about $19,000 this year, it's going up pretty significantly next year. They do suspend your benefit, meaning if you make more than $19,000 and you're taking Social Security, they actually suspend some of your Social Security benefit. So that's always the first question we ask is, are you going to keep working? And then you get into the math piece of it, which is what you're talking about, Luke. So Nate, you want to talk about that, about when you kind of break even and all that kind of stuff?
Yep, it is a break even discussion, to some extent. If you say compare claiming at 62 versus age 67, to file on Kyle's example, the break even is basically at age 78 there, where basically if you have two versions of yourself, the version who claimed at 62 is money ahead because they received a less benefit for 5 years before the other version did, right? The guy who claimed at 62 is money ahead to age 78. If you live past then, you're basically money ahead, all else being equal, to claim at 76 there. So, but that's taking out all of the variables where, like, well, how much do you have saved, right? If we're pulling out 20% from your IRA and then we exhausted in 4 years, it didn't do you very good to defer for 5 years, right? So there is a numerous different examples there, but it's a break-even discussion, based on life expectancy and things like that. But it's also a very powerful longevity insurance because it's adjusted annually for inflation. And the big news is that it's going to increase by 8.7% for 2023. So the longer you live, the more powerful it is to defer and claim later, because having inflation adjusted guaranteed income well into your 90s, is extremely powerful. So.
And it's not. Anyway, it's probably not going to go broke as much as you hear that out there. It's fully funded through 2035, and then like 70% funded after that. So it's going to be around for most of the people on this call. Nate and myself and Luke, we're just going to have to wait till 70 or 75 to get it, probably. But we'll
keep paying in for you. Very good.
Good. Good. Anything else, or should we open it up for questions for everybody?
You can open up for questions. That's fine.
Okay. So again, down at the bottom, there's a Q&A or a Q&A or a chat function. You can enter it there, or there's also a raise hand button down in the center of your screen here. So if you want to click any of those, we'll be happy to answer any questions that you have. Otherwise, if it's something that your advisor here at Klaas could answer for you, you can always shoot us an email or shoot us a phone call. We'd be happy to talk through your personal situation. But if you have some more general knowledge that you'd like from Luke or us, let us know right now. So we'll stay put for a couple more minutes here and see if anybody has anything that comes in. So. Yeah, I would say Social Security is one of the biggest questions we get asked, probably.
It's becoming more and more of a question. Obviously, as client base gets a little bit older, I have people that don't. The biggest question is mostly from people who don't necessarily need it.
Mhm.
Yeah.
And should they take it early? And most of them want to. They come to the conclusion themselves that they want to take it early just so that they can enjoy the dollars. They could go do some extra stuff with that money because they don't believe that they will need it in retirement.
That is part of it too. That's sometimes, we get buried in the spreadsheets and the numbers of mathematically what makes the most sense. And we forget that we're dealing with humans that have worked 40 years to retirement, right? So we understand that, hey, maybe you should wait because we think it's going to work out better if you live to age 95. But you say, well, that's great, Nate, but I still want to enjoy my life when I'm 62 and when I'm young enough to enjoy it. I don't care if I have more money when I'm 85. I'm not going to be doing as much either. So we certainly understand that. And the last point is that, you can claim anywhere from 62 to age 70 every month in between. So that gives you 96 different claiming dates. So that should tell you just there that there's not a right answer. And there's certainly a happy medium of, 64 and 8 months or whatever, instead of, it's not 62 full retirement or 70. That's most commonly quoted. There's 96 different dates you could actually claim it. So.
Good. Oh, we've got a question. Okay, so we got a question here. 73 years old, still making over $100,000 a year with a significant RMD. I'm putting money away in the pre-tax account to decrease my taxes and not adding to Roth. Does this make sense? Probably. It depends on what your income is going to be in retirement is the short answer to that. So if you're still making more money now than you're likely to be making when you retire, you're probably better off going pre-tax now. One caveat would be if you're in the same tax bracket as you are now versus what you're shooting to be in retirement, then it probably isn't as big of a deal. But generally speaking, people are going to be in, if not a lower tax bracket when they retire, usually the same. Occasionally we'll get people that are in a higher tax bracket if they've saved significantly. But at that kind of income of 6 figures, I would say that you're probably going to be in a similar tax bracket. So.
Yep. I would just add too, if this gentleman is referring to that he, if you're working and still have your money in a 401k plan, you actually are not subject to the RMD, correct, Luke? If his money's in the 401k plan and he has an RMD, but he's still adding to it.
Correct.
Yeah, go ahead and follow up on that.
No, I believe that is correct. And I would use the same, I would not be funding the Roth either. I'd be putting pre-tax dollars in because of the rate you're in now is likely to be the same, if not lower in retirement.
Yep.
Yeah. So people think 401ks are like an investment vehicle, which they are kind of, but they're also more of a tax vehicle. So the theory behind them is that you put money in while you're earning income, so that in retirement, when you're in a lower income bracket, you can take it out and pay less taxes. Sometimes that ends up working out. Sometimes it doesn't because most people want to live a similar lifestyle. So you need a similar income. So sometimes you end up actually being in the same, or occasionally if you've saved really well and your 401k is built way up and you roll it into an IRA and you just let it grow and you've got nice pensions, you could actually, because of required minimum distributions, because of Social Security, you could actually have a higher taxable income in retirement. But I would say that's not the most common situation, but it's a good situation, a good problem to have, but it's not the most common one.
Yep. I'll throw out a rule of thumb, and I'm sure Luke doesn't like rules of thumb, but generally you'd want to defer taxes if you're in the 24% bracket up, right? And if you're in the 10 or 12% bracket, that's usually when a Roth could make sense or at least be indifferent. So if you want a rule of thumb, if you're in the 10 or 12% bracket, Roth, or it doesn't make a difference. But if you're starting to get in the high 20%, 30% brackets, more times than not, they're probably going to be in a lower tax bracket in retirement where pre-tax would make sense. Luke, would you generally agree with that?
I would very much agree with that. And I wanted to touch up on what Kyle said. That misconception is that I'm going to be in a lower tax bracket in retirement. Not necessarily true unless you're a very high income earner right now. But like he said, a lot of people want to live the same standard of living in retirement as they were living before retirement. So you basically need the same dollars coming in. So that goes back to this whole planning situation where how can we make those dollars most tax efficient for us? So.
Yeah. Great question, though. Great question.
Yes.
All right. Well, I think if nobody else has any questions, we will get this wrapped up. We'll hang out for another minute or two just in case somebody's got one coming in, but then we will shut this down. I don't know if I mentioned it earlier, guys, but this is going to be recorded. So we will post this up on our Klaas Financial website. It usually takes us a couple of weeks to get them up, but they will be there. So. Okay, another question. When I look at my Social Security projections on their website, it shows the same distribution no matter what month I started until January. Every January it takes the 8% jump, but then stays flat for the rest of the year. But what I read is that the amount is adjusted monthly, not annually. Is their website just inaccurate? Go ahead, Nate.
Yeah. As I say, yeah, it is like whatever 1/32 or I bet the website just shows by calendar year. But yes, each month you defer would specifically have an increased COLA. The 8% that he's referring to is the delayed retirement credits, where every year after full retirement age, they will give you an 8% increase there. But it is credited monthly to the gentleman that asked that question. So yeah, even though the calculator probably doesn't show that from what you said, you would get a 1/32 or whatever the math is of that, 1/8 of it.
Yeah. Be the 8% divided by the 12 months.
Exactly.
It comes out to be.
Yeah.
Exactly.
Yeah. So, and you can always call in and then I would be very specific when you call in to say, hey, I want to, I'm 78 and 4 months. I want to claim as a 70 or 68 and 4 month year old individual to make sure you receive those for 4 months of deferred credit as well too. So.
Mm-hmm. Yeah. Good. All right. Well, those are some great questions, everyone. Again, thanks for joining us. And like I said, this will be recorded, so we'll get it up on our website. But looks like we're running out of time. So please, if you have any other questions, feel free to call our office and ask to speak to one of our advisors or shoot us an email, anything like that. If you would like to get in contact with Luke, please let us know and we'll be happy to get his information over to you as well. But other than that, everybody enjoy what's left of the fall. Luke, thanks for joining us, and hopefully you get a little bit of a breather now. So,
yeah,
thanks, Luke.
Thank you.
All right. Thanks, everybody. We'll talk soon.
Yeah.
Bye-bye.